Hello and welcome to Aussie Property and Wealth. I'm your host, Dilip Kumar, co founder of HALLMARK Buyers Agency. This podcast is about making property simple and accessible so everyday Australian can build wealth through property. Whether you're a first home buyer or just starting property investment or an experienced property investor, the goal is simple to bring you practical insights that help you make smarter property decisions. In each episode, we bring together experts from across property ecosystem mortgage brokers, accountants, property managers, and other professionals to share practical insights that help you make smart and confident moves. My personal mission is to help at least 250,000 Australians, about 1% of the population, move to a stronger financial position through property. Each episode is one small step in that direction. Today, I'm meeting Rajvir. Rajvir is an experienced accountant, an SMSF specialist, and director of digital accounting solution. Rajvir is an expert on navigating complex tax law matters. His motto is keep it very simple, and we can feel it from the very first interaction we have with him. They have offices in multiple locations across Australia. They have a chartered accountant practice. You'll absolutely enjoy having this conversation today. Rajvir, welcome to the show.
Thank you, Dilip.
Thank you. Thank you for having, making time to be here. Today,
Mm.
we want to talk about taxes, CGT, negative gearing, how they work, what's changing from very basic to the most complex level. Basically, we want to cover how to keep most of what we earn and what we invest.
Yes,
That's where we are going to do it.
yes.
I'm really excited, Rajvi, to have this conversation.
Now let's
Um,
let's have a conversation. It's one of the complex area where we get clients asking these questions. I'm pretty excited to have this conversation.
all right. I want to start by putting you on spot in the first go itself.
Okay.
Give me a yes or no answer. Should someone stop investing in property with all the speculations going on around CGT and negative gearing?
The answer is no.
Okay. Okay. Why? Why would you say that?
Look, investing in a property just for the sake of negative gearing or capital growth is one aspect, but simultaneously you need to be aware of, even though the changes in capital gains tax or negative gearing is not a policy yet. But if you stop investing in a property just for the sake that hey, government is just announcing something, or somebody is not just referring to the changes, you should stop investing in a property. As
Hmm.
you buyers agent, you know that there are fear mongering everywhere. You never know until unless we do have a policy document either from a treasury or the Australian government or federal government itself. They're going to know, possibly they are looking to announce this in federal budget, these changes, possibly. But it's not that scary in essence that if they reduce the capital gains, let's say about 10%, 20%, still we can look up the effective tax rate of individual, how much there is impact on the tax liability. So by saying that the answer is no, nobody should be scared just reading some news articles. We should wait till source confirming those changes.
Excellent. Excellent. I think there is a lot of noise going around, and hopefully, this in this podcast we'll be able to unpack
Yep,
starting from the basics. Somebody who doesn't know what is a CGT to the most complex level. But
yep.
before diving into the main part, I just wanted to step back a little bit and ask you this question: how important is it for somebody to understand what are the taxes that they are impacted with, and what are the tools that they have to play with, be
Mhm.
it they're just doing a 9 to 5 job, right, paying tax, they don't even realize, or a business owner, or a investor property or some form, right? How
Yep.
important is for somebody to understand the tax systems and how it is really impacting their life?
Look, from a tax law point of view, it's very complex in essence that if you try to read it, it's not that easy that way it's just a simple line answer. It can get tricky where you have one legislation integrating with the other one, and there would be anti-overlapping rules. That's where our job comes in. But as
Mhm.
an the question is, what person should do who has 9 to 5 job? how much they should know about their taxes is. Look, at the end of the day, they are the taxpayers. They should have at least a basic knowledge how
mm,
tax system works. What are the tax rates? What are the marginal tax brackets are? For example, let's say somebody earning top tax bracket. We usually get this question. They earn, let's say, $240,000. They think that they have to only pay the income tax. But
mm,
hey, as soon as their adjustable taxable income goes beyond $250,000, the additional tax comes in. So
mm,
it's more important for these people where they're earning money from 9 to 5, but simultaneously they should have a basic knowledge of the taxes. It's very important. Rather than just reading 1,200 pages of tax law, just have a basic knowledge. Hey, how much is my income? How it get taxed? What is the marginal tax? So I would say it's it's quite important for the taxpayer to know where they are.
excellent, excellent. Thank you for giving that clarity. I think the
Uh,
I just wanted to ask one related question, right?
yes.
The same situation, like whatever they are, like working 9 to 5, or like as you said, like they speak with three different specialist accountants, or like I let me use the word specialist, right?
Yeah.
We don't People expect to get the same answer, but mostly they get different answers, and sometimes the difference is so huge, and the impact. Why do
Yeah.
you think this is happening? Is it because how the tax laws are interpreted, and how different um, you know pieces of the puzzle are being worked by different
Yeah.
specialists? Is that why
Yeah.
it is?
Look, it's more into the taxpayers conversation with the specialist as well. Let's say if somebody just want to, usually it it might be the gap of the knowledge between the taxpayer and the specialist. Sometimes they ask a different question, or they interpret the question differently to the tax practitioner or the specialist.
Mm,
So that's why one of the reason is that's why they are getting different answers.
mm,
Uh, but by saying that everybody has their own interpretation of tax law, and they
mm,
might be thinking from a different angle compared to the other practitioner.
mm,
Okay?
mm,
So it's all over. We usually come across these scenarios quite often,
mm,
and we might have a different way of view to look up the transaction itself. So
mm,
it's more into the transaction itself where the
mm,
client has presented the facts,
mm.
and that's what the advice come from.
Excellent, excellent.
Yeah.
Thank you for providing that clarity. I just wanted to dive into the basics of CGT. If somebody doesn't have a clue of what is CGT, capital gain tax or
Yeah.
negative gain,
Hmm.
right? How would you help them understand what is that? Then
Yeah.
let's talk about some of the complex aspects
Yeah. That's
related.
one. Look, from very simple definition of capital gains, I will try to be as simple as I can. What capital gains is, what capital gain tax means itself. It's a tax on disposing or transferring the capital assets.
Mm,
Okay, what capital assets could be? Property, shares, collectibles, bullions, whatnot. Okay,
mm,
there are different rules around each assets because
mm,
again, it's just not one of the aspect where you just dispose the asset. For the property transaction, probably there are various rules where we got few clients where I just don't want to dive into the margin scheme or isolated transactions,
mhm,
but we got a few clients where they buy a land and develop the property, and they
mhm,
think that it can cover under the capital gains tax.
mhm,
There are few exceptions to that
mhm,
in terms of whether it would be treated as an capital gains assets
mm.
or as an revenue account. All right. So that's the capital gains definition. You
Okay,
dispose of capital asset, and government or the Australian tax office levy tax on that. Now,
okay.
from the concession point of view, there is a 50% discount as of today
Mhm,
if you hold more than 12 months.
mhm.
Okay, if you have a business asset, then there are small business CGT concession, which I think it's outside of scope of this
For
discussion.
today's conversation, yeah.
Yeah.
Mm,
Yeah.
yeah.
So predominantly, the biggest scary bit where news bait is coming up, hey, government going to reduce 50% discount. That's where the focus is. But at this stage, nothing has been formed for now.
Okay, okay. So in a very, very simpler term, the way I understand is, if somebody does some from investment, 500,000 investment in some asset class or something, and if that turns into, let's say, 1.5 million, so the growth is 1 million. So basically the tax that they pay on that growth is what is capital gain tax, and there are
Yeah.
different flavors of it, how it is
If there
being.
are discounts if
Yes.
they are holding for 12 months or more.
Okay.
It's
All
a, it's a simplest form. You can say that.
okay. Now, how about negative gearing? What
Okay.
is negative gearing? If somebody has no clue, what is negative gearing? How would you like to explain that?
Negative gearing is very simple way to put it up in a puzzle is if you spend $100 on receiving a rent, or for example, let's say you buy a property, a
Mm,
capital asset,
mm,
and you receive income from it, and the expenses are more than the income.
mhm,
That's a negative gearing. Now, what
mm,
negative gearing does is it reduces your taxable income.
mm,
It won't give you tax offset, but it will reduce your taxable income.
Okay.
Okay. For example, let's say if you receive $100 as a rent,
Mm,
your expenses are 120, including cash and the depreciation.
mhm,
Your negative gearing is $20.
mm, okay.
That $20 would reduce your taxable income by $20. So
Okay.
that's the negative gearing. Now, I know a few senators are trying to limit that to one property, two property, three property. I don't know. At this stage, it just so much a noise outside where we get these calls. Hey, what's going to happen? Should we dispose of? Hey, no. Until unless we get something in writing from the government, I think we should wait because rather looking at the economic outskirts as well, we're looking at Iran, America, Israel, or and yesterday governor also said, "Hey, we might take you to the recession." We are not saying, "Hey, we won't we
Yeah.
won't stop the hey," but they are saying, "Hey, if we have to take you to the recession, we will take you to the recession." But
Mm, mm,
again, it's just the speculations uh, in terms of what will happen.
okay. Okay. So for somebody who's has no knowledge of negative gearing, they just need to understand that this is one way where the loss on their investment for that current financial year is going to
Yeah,
help them manage their taxable income,
yeah,
thereby they're able to get more money out of their
that's right.
tax that would have gone.
That's
Yeah.
right. That,
Oh,
that, that, the money, the bit, Dilip, I just want to clarify hey, one thing, because usually, let's say somebody's paying the taxes, higher taxes,
mhm,
somebody's at 47 cents to the dollar tax rate, including the medical levy.
mhm,
What what they will get is they will get 47 cents back from that
mm,
law.
mm,
Okay.
mm,
Now there are two components out of which one is the cash and non-cash,
mhm,
which we can explain. Cash is clearly stated whatever you have spent.
mm,
Non-cash would be the depreciation expense or capital works for that rental property.
mhm, mhm,
Okay. Those together, whatever the loss is, it will reduce their overall tax liability. So I'll put it up rather than saying that, hey, you will get a huge refund. I'll say, look, your overall tax liability will come down.
yeah,
Now, whatever your employer has paid the taxes to the ATO, you will get the difference when we do the tax return,
yeah,
which is technically a reconciliation of tax payable versus tax paid to the ATO.
yeah. Okay. Okay. So having a very good understanding of capital gain tax, how that impacts them with whatever
Hmm.
they're doing, and negative gearing, I
Hmm.
feel it is very essential even before they start investing or going down that path, because I can see there is a lot of myths around these two areas, and it is not straightforward in many cases, but people should take time and effort to
Yep.
get that clarity what it means for their scenario,
Hmm.
both in terms of short term and long term.
Yep.
Yeah.
Yep.
Okay. So thank you for that, providing that clarity, Rajvir. Now, CGT. Let's talk a little bit about CGT. We hear this word a lot in the news, right?
Hmm.
About something is going to change, or something is about to change, or something like that. Give us a little bit more clarity on what is it currently and what is it going to change, or likely scenario that they are proposing. Let's break that part a little bit.
Look, from a news point of view, because I'm reading a few news articles this morning from various newspapers, they are saying, "Oh, Labor don't have any policy as such.
Mm-hmm,
Their treasury is looking at such and such document. They're doing all these estimates, whatnot.
Mm-hmm.
Number one is that it's just a fear mongering at this stage,
Mm-hmm.
or you can say clickbait. But by saying that we know that they may change in a federal budget,
Mm-hmm.
which will they will announce beforehand. They won't just go in and smash hammer
Mm-hmm.
on people's head.
Mm-hmm.
That's number one. Now, let's assume there is a capital gains change,
Mm-hmm.
and they are, because at this stage we are 50% discount, which makes our effective tax rate is 23.5% if somebody disposes of a property. For example, if they make $1 million worth of gross capital gains, multiply by 23.5%, you will get $235,000. That's the maximum tax you have to pay, because after the discount, if you discount a million to 500, then apply 47 cents to the dollar, it's almost the same
Yeah.
figure you get.
Mm.
Now let's assume on that same $1 million, government reduce the taxes by 10%, reduce to 40% capital gains
Mm.
tax.
Mm.
Now, it's not end of the world from investor's point of view, because the effective tax rate is going to jump to 28.20%.
Mm. Mm.
Okay. What it means, it's 5% extra, but hey, simultaneously, you need to understand that if you're holding more than 12 months, you
Mm-hmm.
still have a better outcome than a
Mm-hmm.
non-small business entity, which is a company, holding
Mm-hmm.
through a company. Okay.
Mm-hmm.
Let's say government decide they bring it to the 30%.
Mm-hmm.
Then again it will jump to 32.90%.
Mm-hmm.
It would be higher for investors than a company tax rate, but they can look into buying properties either through different structures.
Mm-hmm.
But they have to be mindful of the negative gearing whatnot,
Mm.
because a few of the structures crystallize the losses in structure itself.
Mm. 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 Mm.
Okay. Let's say worst case scenario, I'll put it up. They reduce the capital gain discount to 10%. The
Mm-hmm.
effective tax rate is 42.30%.
Mm. Mm.
Okay. So you can see that every 10% increment, it's going 5% extra
Impact.
in effective tax rate.
Mm. Mm. Okay. Okay.
Okay.
So all of this is being proposed, and if my reading is correct, and this is not the first time this conversation has started, isn't it? Like,
Yep.
they have discussed about it, or like, they have speculated about it. For some reason, they have not decided to apply it. So we really don't know in the current situation if those changes are going to be implemented or not. But from what you just explained, though it sounds a little scary when we look at the news, but when we actually work the numbers,
Numbers.
we're
Yeah.
talking about, like, the changes could be at the level of 5%, 10% in the actual profit that we are making.
Yep. Yep.
So it is not as scary as somebody it can work out,
Yep.
may think of. Yeah.
Yes.
Okay. And you were actually, like, making a very interesting correlation between, like, when the effective tax rate is changing, and what entities you can buy in, like, company and everything, right? Can you
Yep.
elaborate a little bit on that? What were you trying to explain there in a little
Look.
bit more detail?
Yep. Look, if somebody buy a property through company structure, from it's more into the tax perspective. It's not financial advisor or anything.
Mm.
Uh, from the tax point of view, what they're going to do is, let's say, the years they're going to hold that property, they're going to accumulate all those losses, because company won't able to get a negative gain,
Mm.
and it can't pass on to the individual taxpayer. It will
Mm.
crystallize and quarantine inside the company.
Mhm.
So all the negative getting going to accumulated way, and when they're going to sell the property, let's say if their gain is $1 million, first they have to deduct it with the tax losses.
Mhm. Mhm.
Okay? Then the tax rate is 30%.
Mm.
Okay. Now that tax 30% would be sit in a franking account of the company,
Mm.
which they can later distribute it to themselves.
Mm.
Okay. So it's more complex than individual tax returns,
Mhm.
because what happened with that is, now how are you going to distribute the remaining profit out of the company? If you take out as it is, then there would be division 7A issues,
Mm.
whatnot, where tax office might declare unfranked dividend and they make you pay the tax. But
Mm.
by saying that, it quarantine those franking credits in the company as well.
Mm. Mm.
When you declare those profit out of a company, you
Mm.
won't pay the double tax. but you're going to pay the difference between 30% versus whatever your tax rate. If
Mm-hmm.
your tax rate is less than 30%, you will get a tax refund. Because as of today, I'll just repeat myself. As of today, franking credits are refundable. If you're, let's say, for example, your effective tax rate is 20%, you have paid 30% in the company, you will get 10% difference of the franking credits
Back.
back because
Yeah.
you had paid 30% in the company.
Yeah.
If you would have disposed of, whereas in an individual case, you just paid and done and dusted with it.
Yeah. Okay. So it's almost like you're not paying dual tax for the same amount of money.
That's right. That's right. That's right.
Different technical terms you're
That's
talking.
right. The only drawback here, Dilip, is the cash flow.
Mm-hmm.
People think that, hey, you buy under different structure, but hey, the losses are quarantined there or crystallized there,
Mm.
and it just the cash trap would be there. Okay? As long as they're not going to sell it, that will stuck there forever. Now, when they sell it, then retained profit has to be distributed out to the shareholders.
Okay. Okay. That
Okay?
makes sense.
So simultaneously, same thing happened with the trust as well.
Mhm.
I just want to touch on to the other structure as well, which is quite famous. We saw a few of articles about the trusts,
Mm.
whatnot.
Mm.
Trust does the same thing. Trust can't distribute profit out of the trust
Mhm.
until unless you make it. Now,
Mm.
with the discretionary trust, you still have a position where you can distribute it to your family members, all the
Mhm.
profit,
Mhm.
or to yourself, because it's a discretionary and the trustee has the discretion. Okay?
Mhm. Mhm.
There are a few tax law aspects we have to make sure, but it's. I'm just giving you a very simple scenario.
Yep. Mm.
The other aspect for the trusts are why people are discouraged to buy property through the trust is possibly in a news articles as the land tax is the biggest killer,
Mhm.
and they charge land tax on $1
Mm.
rather than giving a tax-free threshold.
Mm. Mm. Mm.
Okay,
Mm.
so these two structures uh, they are good investment vehicles, but hey, from cash flow point of view, one should be aware that hey, these are the tax implications.
Mm. Mm.
They
Mm.
should know that hey, somebody invested in the losses is quarantined, no tax benefit until unless you sell the property.
Yeah. Okay. I think you've touched upon a very important part, apart from explaining the different entities, is the one component about land tax. But I'm going to park that because land tax is one of the uh, big hidden thing many people don't even realize. Maybe we will have a separate conversation on land
Yes,
tax and
yes,
how it changes for different states and how it is impacting different entities when they are buying
yes,
that.
yes,
So that's a very interesting conversation to have. But now it's thank you for giving that clarity about CGT. What are the scenarios and what people can do to navigate through it, right? The
mhm,
the crux of what I've heard from you so far is number one is at this point everything is speculation or being discussed. We don't
yep,
know if it's going to be implemented or not. If it is going to be implemented, we don't know in what shape or form it is going to be there.
yes,
The third thing and the most important thing is we don't know what impact it is going to have on the current investment and what people need to do. The best
yep,
thing is speak with the right expert, ask the right question. The
yep,
scenario needs to be worked out so that
yep.
they are not assuming things and making a mistake because these can be huge ones in terms of opportunity cost and other stuff, right?
That's right. That's right.
Yeah. So now, if you want to slightly shift our focus to negative gearing,
Yep,
right? It is another big thing which seems to be, discussed a lot in news today.
yep, yep.
What is that being discussed that can change in negative gearing itself?
Yep. Look, at this stage, few senators are proposing one. I think I was reading one of the Treasury document in back in 2025. They were discussing to limit the negative gearing 1 to 2 properties
Mm-hmm.
because at the end of the day, government want to generate a tax revenue. That's their motto. Okay,
Mm-hmm.
they function on that, and people had identified this negative gearing to reduce their taxes and simultaneously create wealth. Simple as that.
Mm.
Now, the other possible outcome we may see is that they might restrict the negative gearing to the brand new properties
Mm.
because they want to increase the supply of the new dwellings.
Yeah.
Okay, so they might encourage people to just invest into the brand new properties, get a negative gearing, whatnot.
Mhm.
But it would be complex in terms of navigating what property they should be selecting. Let's say if they tell you you need to you can only claim two properties, would it be first in first out or last in last out? So
Mhm.
which one would it would be? It would be interesting to see from the government perspective what would they put it up a dollar value on the they can claim only up to $10,000 worth of tax deduction. I
Mhm.
remember 2019, Bill Shorten tried to implement same thing with the accounting fees. They tried to limit the dollar value to the
Mhm.
$3,000, and
Mhm.
it was knocked down by people
Mm.
saying that hey,
Mm.
it's not feasible.
Okay.
I think it's quite interesting what they're going to propose.
Mhm.
But my theory or my hypothesis around that is if they try to limit the negative gearing, it might have bad impact or domino effect on a rental market where they are just uh, reducing the incentive people to buy investment properties. Yes,
Mm.
it
Mm.
might be the leakage of uh, uh, tax revenue right now. But hey, when they're going to sell the property, they're going to make the capital gains and they're going to pay the tax at least 23.5%. It's not small amount. Government won't think that part. It's they
Mm.
want more.
Mm. Mm.
Yeah. So that's what we are expecting it to be changed.
Okay.
But as of today, like you open up a news article, it's oh hey, end of the world, sell, sell, sell.
Yeah. Either they open the news article or go to ChatGPT. Hey, what's happening? Right? And one of the other, right?
Now,
Um.
I was looking at this article interestingly this morning on Yahoo News. They were saying that they look at it. The economists or the people in the newspapers, they know if there is a grandfathering provision in these negative getting capital gains, people rush in. I can
Right.
tell you, people are going to rush in to buy the properties because
Mm.
they know if they buy before certain date, the change is going to be implicated
Mm. Mm.
and it's going to have a huge upside in the property market, and it's going to make everything worse.
Yeah. And
Okay.
can you explain what is this grandfathering? I think I have a basic understanding of it,
Yeah.
but what does grandfathering mean, and how does it impact? I mean, apply to the CGT and negative gearing scenario that we're
Look,
talking.
grandfathering means what the government do with the previous transactions. Let's say
Okay.
somebody holding the property right now. One of
Hmm.
one of the possibilities in what if analysis is that government might say, hey, after 30 June 2027. I'm just speculating up here. It's nothing confirmed.
Hmm.
Let's say if government say after 30 June 2027, whosoever buy a property won't be covered under the capital gains or negative gain.
Ah. Okay.
So
Hmm.
it would be like more into the gold rush, where people say, hey, buy it now rather than buy after 30 June 27.
Okay. It's almost like, drawing a line in the sand and saying
Yes,
that,
yes.
anything before this, this
Before
is this is the rule that's going to apply. After that, this is the rule going to
that's right.
apply.
That's
And
right.
I can see that, if they put that as a future date,
Yep.
as you said, sometime in 6 months, 12 months, and everyone is going to rush into it, and
Yes.
that can create its own dynamics, right?
Yeah.
But the important thing, when you're in the conversation, you spoke about, tax revenue is the biggest form of income for any form of government, right?
Yep.
and
Yep.
and it has so many different impacts. I think that's one of the reasons why it is not a straightforward way. Even the best of the best economists are trying to speculate and, decide, if you change this is going to happen, that is going to happen. Sometimes it backfires also. For example, now the 5% scheme change that was implemented in
Mm.
October, on the surface really look, but it has really pushed the property prices to a different layer, different
Mhm.
segment of it. I'm not sure, if it has really solved the problem for which the changes were implemented. Some people seem to be getting the benefits, but others seem to be suffering more because the property prices were, going up, up, up.
Yep.
So
Yep.
these are really complex matters per se,
Yes.
right? And
Yep.
it can change heavily depending on individual circumstances and everything.
Yep.
Um, how important it is for somebody to, do the due diligence before they buy an asset. Let's say before buying a property or this one. Like
Mhm.
sometimes people just do it because their friends told them, "Hey, this is the best way to do it." How important it is there, and like what is that they can do before buying it? Like is this a conversation with any accountant or any tax specialist, or is there any sort of a specialist that they need to look at before they decide on that option?
Look, I have seen a few family trusts being set up without exclusion of foreign residents. Okay?
Hmm.
So what it means, different state had different rules around it. Because somebody saw one YouTube video saying that, hey, buy another family trust, you will be millionaire, billionaire. All right.
Hmm.
So, but what they can do, the worst thing they can do is they can buy offshore deed
Hmm.
and buy the property without realizing that
Hmm.
they are going to get stamped, everything. Okay. The
Hmm.
next thing you know is that you would hit with a land tax surcharge
Hmm. Hmm.
on a non-resident clause because you never included it in it. So
Hmm.
it's quite important. It's just one of the examples. It's not uh, a standard or a format example, but it's just one of the examples where we saw a few deeds where they don't have a non-resident clause. Uh, it's very important to have the deed reviewed by a legal person. The reason for that, they are expert in that. So, by answering your question, look, it's mix of everything. You can't just purely rely on your friend's advice, or you
Hmm.
can't rely on your expertise itself, because
Hmm.
hey, you might be missing something where the professionals may point it out to you, saying that hey, you need to do this way. Okay?
Hmm. Hmm. Hmm.
Okay. So it's quite important to have a discussion. It's nobody going to bite you if you give them a call and say, hey, I'm doing that. You know,
That's a very good point you say. Yeah.
you know,
People are sometimes afraid to ask that question.
that's right.
And
Look,
and
if,
most
if
of the initial conversations are obligation free, right? No,
yeah, that's
you're
right.
not wasting their time, but at least asking the right questions. Yeah.
Yeah, you just pick up a phone, ring your accountant saying that hey, I want to do that,
Yeah.
and get their opinion, and they are in the best position to guide you in terms of
Mm.
navigating these complex rules.
Mm.
And
Mm.
simultaneously, you would have your buyer's agent like Dilip, whatnot, and having a mix of a team would give you best outcome you can achieve. You know?
Absolutely, absolutely.
Yeah.
One thing I've also noticed, like I think whether they are investing in property or not, like pretty much everyone trusts their accountant. This is
Yes.
invariably I've seen. I've
Yeah.
spoken to so many people, but they trust their accountant
Yeah.
because they are the ones who are getting them tax back, income tax back, and everything. I've seen that like there is a natural this one, and the slightly negative thing I've seen is when someone who's a tax specialist is also not an active investor or like in that mindset, sometimes they pass it on to their clients, right? So that's the reason like I encourage when somebody speaks with me is like ask the accountant or this or anyone they work with,
Yep.
how are they like viewing property investment or investment in general.
Yep.
If
Yep.
that goal doesn't align, maybe it is not going to give us the best outcome, right? I find that to be like a really litmus test whether somebody should continue working or not. It's almost asking the right questions to them,
Yep.
because when they are interested, as you rightly said, they would have keenly learned about the different things that are impacting across different states and
Yep.
everything. So that is
Yep.
something that I noticed. But do you see like because you speak with so many different people, business
Yep.
owners and everything, and sometimes they are moving from one specialist to the other specialist and things are different. So what do you see that angle there?
Look, from it's more into the phase of the accounting practice itself. Some accountants are old and they try to avoid the client or have a conversation. Want to do a compliance.
Yeah, yeah. Hmm. Yeah. Okay. Okay. All right. So I wanted to touch a little bit about SMSF,
Mhm.
right? The CGT and negative gearing. If you have to look through the lens of SMSF and somebody who have bought that property on SMSF, how does it work?
Look, before I start, I will put it up a disclaimer. We are not the financial advisors. Any communication or any discussion is general in nature, and nobody should take our advice to set up SMSF
Yeah.
or or invest in SMSF. But we are just going to discuss purely on the tax aspect and
Mm-hmm.
the tax implications on the SMSF.
Mm,
Now,
mm,
look, SMSF is also a taxpayer, which would be separate from the individual, but the tax rate are quite significantly lower
mm,
uh, to compared to the individual or other structures. The main objective of the SMSF is that the fund has to be for your retirement.
mm-hmm.
No other use are allowed in the society. Okay, let's say if somebody buy a property and they do the negative getting through the SMSF, potentially they should be looking at doing a positive gaining because the overall objective is that you want to make sure that fund is generating cash,
Mm-hmm.
and the tax rate on that earnings is 15%. Okay,
Mm,
that's the main objective for the individual. But let's say if somebody buy a brand new property and they are in early 30s or early 40s, they do have a quite a bit of time to go for a retirement. But by saying that they can offset their negative getting with their other earnings, such as employer contribution, whatnot. Okay,
mm-hmm.
that's the tax aspect.
Mm,
From the capital gains point of view, it will be taxed at 15%,
mm-hmm.
whatever the gross capital gains, if it's less than 12 months.
Mm-hmm.
But if somebody hold more than 12 months, the effective tax rate is 10%.
Okay.
Okay, because effective tax rate, because maximum is 15,
Mm,
and the discount rate is 33.33% in super
mm,
SMSF.
mm, mm,
So which is lower than individual, which is currently at 50%,
mm-hmm.
and SMSF is 33, but effective tax rate is come down a bit, which is 10%.
Mm, mm, mm.
And it's
Okay.
more, it has a different treatments when it comes to accommodation phase to the pension phase.
Mm,
Whereas somebody is in a pension phase, dispose of a property, as of today, if they have ECPI exempt current pension income, they don't have to pay any taxes on the earning of that investment
mm,
if they are
mm.
if they are in a retirement phase. If the full fund is on a retirement phase, but
Okay.
that's something they should be discussing with their financial advisors.
Yeah.
Okay, so that's the difference between SMSF versus individual versus companies or the
Okay.
trusts.
So the current changes that are related with CGT is not really impacting the somebody buying an investment property or that scenario.
Mhm.
That's completely different. Is that right?
Now, look from the capital gains discount perspective, because if they are not going to look it up only the individual taxpayer
Yeah.
or the trust itself, because these are there are certain restrictions who can get the capital gain
Yeah.
discounts. Okay?
Mm-hmm.
One of them is the SMSF. Now they
Mm,
may or may not touch the SMSF because they
mm-hmm.
already at 33% or the lower tax discount than individuals.
Mm-hmm.
But it would be interesting because technically you're going to pay additional 5%. If they make a capital gain discount for the SMSF zero, and they say
Mm-hmm.
we want to charge everything, hey, the effective tax rate will be jumped to 15%. That's the max.
Okay. Yeah. Yeah.
Okay, it's a 5% increment even though they make it zero, but it's very unlikely, very very unlikely
Mm.
to reduce that to zero.
Okay. Okay. So that still again just like how we discussed on the other area. So this also is an area where we need to wait to watch what is in terms of that negative gearing thing you mentioned. Oh, Rajvir, thank you. Thank you for giving us that clarity about about CGT, negative gearing, and the different flavors of it, how it is impacting. We did have some technical issues, but we will have another conversation very soon to cover other areas like land tax or do a deep dive on SMSF and everything. Really enjoyed this conversation, learned a lot, and hopefully everybody watching this video also have learned a lot. Thank you for your time. Take care.